On the night of December 3rd, 1999, a fire broke out in the penthouse of the Belle Epoque, one of Monaco's most exclusive residential buildings. The apartment belonged to Edmond Safra, one of the wealthiest and most secretive bankers in the world, a man whose fortune was estimated at somewhere between $2.5 and $5 billion, whose clients included heads of state, royal families, and the kind of people whose names never appear in newspapers by design. The fire was small. The building's staff contained it within an hour. By any reasonable assessment, everyone inside should have survived. Edmond Safra did not survive. He was found in a marble bathroom, barricaded behind a locked door with 2 nurses, dead of smoke inhalation. He had been alive when the fire started. He had the means to escape. He had people around him. He chose to lock himself in a bathroom and wait, and by the time help arrived, the wait had killed him. The official investigation concluded that one of his nurses had set the fire deliberately, then panicked when it spread beyond what he intended. The nurse was convicted. The case was closed. Almost nothing about this explanation has ever fully satisfied the people who examined it closely. Edmond Safra had spent 40 years building the most trusted private banking network in the world. He had survived a corporate smear campaign that destroyed lesser men. He had accumulated enemies the way other men accumulate assets, methodically across decades, without entirely meaning to. This is the story of how he built it all, and why the night it ended still doesn't make complete sense. The Safra family story begins not in Monaco or New York or Geneva, but in Aleppo, in the northern Syrian city that was once one of the great commercial crossroads of the ancient world. For centuries, Aleppo sat at the intersection of trade routes connecting the Mediterranean to Persia, to the Arabian Peninsula, to Central Asia, a city where merchants of a dozen languages and 3 major religions conducted business across cultural boundaries that elsewhere produced conflict. The Sephardic Jewish community of Aleppo, known as the Syrian Jews, or colloquially as the SY community, had been present in the city since antiquity, and had expanded dramatically after 1492, when the Spanish Inquisition expelled Jewish communities from the Iberian Peninsula. Those expelled families brought with them something more portable than property: commercial networks that spanned the Mediterranean, languages that allowed business across borders, and a cultural tradition that placed enormous emphasis on trustworthiness in financial dealings. For a community that had been expelled once, the ability to be trusted across borders was not an abstract virtue. It was survival infrastructure. The Safra family was part of this community. They were bankers and merchants in Aleppo across multiple generations, operating in the tradition of family finance that the Sephardic community had developed over centuries. Private, relationship-based, built on reputation rather than advertising, serving clients who valued discretion above all other qualities. Jacob Safra, Edmond's father, understood this tradition from the inside. He operated a banking and money exchange business in Aleppo that served the Syrian Jewish community and the broader merchant class of the region. The business was not large by the standards of what his son would build, but it was real. A functioning financial institution that survived on the integrity of its relationships and the precision of its accounting. Edmond Safra was born in 1932, the 4th of Jacob's children, in a Aleppo that was already beginning to feel the pressures that would eventually disperse the Syrian Jewish community across the globe. The political situation in Syria was unstable. The region around Palestine was approaching the crisis that would produce the State of Israel in 1948 and reshape every Jewish community in the Middle East simultaneously. For a family whose commercial existence depended on stable relationships and predictable legal environments, the trajectory was concerning. Jacob Safra read the trajectory correctly and moved. In 1949, the family relocated to Beirut, which was in its brief golden era as the banking capital of the Arab world. Cosmopolitan, commercially sophisticated, and briefly stable enough to serve as a platform for the kind of financial operations the Safras understood. Then, as Lebanon's political situation also began to destabilize, the family moved again. The next stop was Brazil. Sao Paulo in the 1950s was experiencing an economic expansion of remarkable velocity. The country was industrializing, its middle class was growing, its need for sophisticated financial services was outrunning the domestic banking industry's capacity to provide them. For a family with the Safras' background, private banking, foreign exchange, the particular expertise of managing money across borders for clients who didn't advertise their wealth, Brazil was an extraordinary opportunity. Edmund Safra arrived in Brazil in his early 20s with the skills his father had taught him and the instincts that generations of Sephardic financial culture had deposited in his orientation toward the world. He understood that banking at its most fundamental level was not about money, it was about trust. Money was the medium, trust was the product. He founded Banco Safra in Sao Paulo in 1955. He was 23 years old. The bank's initial focus was the Brazilian Jewish community, a clientele that Safra understood culturally, that trusted him by inheritance and reputation, and that had financial needs that the Brazilian banking mainstream wasn't particularly well positioned to serve. Foreign exchange, international transfers, the management of assets that needed to move across borders. These were the early specialties of Banco Safra, and they were specialties that Edmund Safra possessed with unusual depth. He was, by all accounts, a man of extraordinary personal discipline. He worked long hours with a focus that subordinates found both inspiring and exhausting. He had a memory for numbers that bordered on the photographic. He could recall specific figures from transactions years after they occurred, and was known to catch errors in account statements that had passed through multiple layers of review. He dressed conservatively, lived modestly by the standards of what he was accumulating, and maintained a personal manner that was formal without being cold. He was also deeply religious. His Sephardic Orthodox Judaism was not performative. It was structural, the framework through which he understood obligation, trustworthiness, and the relationship between how you conduct yourself in business and who you are as a person. He observed the Sabbath with absolute consistency, regardless of what was happening commercially. He maintained dietary laws with equal rigor. His philanthropy, which would become enormous, was rooted in the Jewish concept of tzedakah, the obligation of charity as justice rather than generosity. These qualities, the precision, the discipline, the religious framework, the cultural rootedness, were not incidental to his commercial success. They were its foundation. In the business of private banking, where the entire product is the client's confidence that you will manage their money with integrity and discretion, the character of the banker is the institution. Edmund Safra's character was the institution, and he was about to take it global. Private banking is a phrase that gets used loosely to describe a range of financial services, but in its most essential form, it describes something specific: the management of significant wealth for individuals and families who want that management conducted with absolute discretion across borders. with a level of personal attention that institutional banking cannot provide. The clients of true private banking are not merely wealthy. They are wealthy in ways that create complexity in multiple countries, in multiple currencies, across multiple generations, with exposure to political risks that ordinary investors don't face. They are the families of business dynasties and deposed monarchies and political leaders whose fortunes are spread across jurisdictions precisely because concentration creates vulnerability. They are people who have learned, through history or through personal experience, that money kept in one place by one institution in one country is money that can be taken. Edmund Safra understood this clientele because his family had been part of it. The Sephardic Jewish experience of expulsion and migration was a masterclass in the management of portable wealth, in how to move capital across borders, how to maintain financial relationships in multiple locations simultaneously, how to build the kind of trust that survives political upheaval. He built his banking empire around this understanding with a clarity of vision that his competitors, many of whom were larger, better capitalized, and more established, never quite replicated. The next major step after Banco Safra in Brazil was the Trade Development Bank in Geneva, which Safra founded in 1956. Geneva was not an accident. Switzerland's banking tradition offered something that no other jurisdiction provided with equivalent reliability, legal protection for client privacy, political neutrality that had survived 2 world wars, and a regulatory environment that treated banking secrecy as a matter of national policy rather than a loophole. For Safra's target clientele, wealthy families from the Middle East, Latin America, and the former Ottoman world, Geneva was the natural destination for money that needed to be safe from the political instabilities of its home countries. The Trade Development Bank gave them a Swiss institution managed by a banker they could trust personally, whose cultural background they understood, whose reputation was built on the same foundations of Sephardic commercial integrity that their own families recognized. The bank grew steadily through the 1960s and into the 1970s, accumulating deposits from exactly the clientele Safra had targeted. The geography of his client base followed the geography of political instability. As countries in the Middle East went through revolutions and nationalizations and regime changes, their wealthy citizens moved money to Geneva, and many of them moved it to Safra. The 1979 Iranian Revolution alone generated an enormous inflow of capital from Iranian families who had seen the revolutionary government begin nationalizing private assets. Egyptian money had moved after Nasser's nationalizations in the 1950s and 1960s. Lebanese money moved as the civil war made Beirut's banking sector increasingly untenable. Each political crisis in the broader Middle East was, from a certain angle, an advertisement for what Safra was offering. This is not to suggest cynicism on his part. He was not manufacturing instability for commercial benefit. He was simply positioned to serve people who needed exactly what he provided. And the world was, with terrible consistency, producing those people in quantity. The expansion to New York came in 1966, when Safra founded Republic New York Corporation. The American operation was a different kind of institution from his Swiss and Brazilian banks, more public, more regulated, subject to the scrutiny of American banking authorities. But it served a complementary function. New York was the financial capital of the world, and having a presence there gave Safra's clients access to dollar-denominated assets and American financial markets through a bank they already trusted. Republic New York grew into something larger than Safra had perhaps initially intended. It became a publicly traded company, listed on the New York Stock Exchange, with assets that eventually exceeded $20 billion. It was not purely a private bank in the traditional sense. It took retail deposits, it had branch offices, it operated with the visibility that American banking regulation required. But its competitive advantage at the upper end of its client base remained what it had always been: the Safra name, and what that name meant to people who understood it. The name meant something specific. It meant that when you gave Safra your money, it would be managed with a precision that left nothing to chance, with a discretion that meant no unauthorized person would ever know the details of your account, and with an integrity that was backed not just by regulatory requirements, but by the personal character of the man whose family name was on the door. Safra was not the largest private banker in the world. He was not the most famous. He operated deliberately in the shadow of his own reputation. His clients were supposed to know his name, and nobody else was supposed to need to. But among the specific clientele he served, he was regarded with a trust that the larger Swiss banks and American investment houses could not replicate. His personal life reflected the same qualities as his professional one. He married Lily Watkins in 1976, a Jewish woman from Brazil who had previously been married to Alfredo Monteverde, a wealthy Brazilian banker. Lily was vivacious, socially engaged, and extraordinarily well connected in the global circles of the very wealthy, the kind of person who knew everyone who mattered in every city that mattered, and who brought to the marriage a social dimension that Edmund, for all his qualities, was not naturally inclined to cultivate himself. Their partnership was genuine and complementary. Edmund managed the money and the relationships that were built on financial trust. Lily managed the social infrastructure, the charity galas, and the Monaco social calendar, and the friendships with royalty and heads of state that kept the Safra name visible in the right rooms. They were, together, considerably more formidable than either would have been alone. The late 1970s and early 1980s represented the height of Safra's power and reputation. His banking empire was operating across 3 continents. His client base included some of the wealthiest families in the world, and his personal reputation was unimpeachable in the circles that mattered to him. Then American Express entered the picture, and everything became considerably darker. But before the darkness, it's worth understanding precisely what had been built. The architecture of trust and discretion and personal reputation that made Safra simultaneously the most sought-after private banker of his era. And, because of the clients that reputation attracted, the target of the most sophisticated corporate attack in Wall Street's particularly colorful history of corporate attacks. The empire rested on a paradox. Its strength came from the same thing that made it vulnerable. Safra's value to his clients was absolute discretion, the guarantee that their affairs would never be discussed, their balances never revealed, their identities never disclosed to anyone who didn't have an absolute right to know. This discretion was what the wealthiest and most private people in the world were paying for, and Safra provided it with religious consistency. But the guarantee of discretion is only as strong as the reputation that backs it. Attack the reputation. Suggest that Safra's operations were connected to money laundering, to organized crime, to the kind of clients whose money came from sources that polite society preferred not to name, and the entire edifice could be destabilized. The clients whose deposits were the foundation of the empire would have reason to question whether the man they trusted was who they thought he was. This was not a vulnerability that Safra had overlooked. He was aware of it and had spent his entire career building the reputation that protected against exactly this kind of attack. What he hadn't fully calculated was that the attack, when it came, would be funded by one of the largest financial institutions in the world. To understand what American Express did to Edmund Safra, you need to understand what Edmund Safra had that American Express wanted. By the early 1980s, American Express was in the middle of a strategic transformation. James Robinson III, its chief executive, had decided that the company's future lay in becoming a comprehensive financial services giant, not just travel and credit cards, but banking, investment management, insurance, the full spectrum of financial products. He was buying companies to accelerate this vision, and the company he most wanted in the private banking space was the Trade Development Bank. Safra was not enthusiastic about selling. He had spent his life building a personal institution, something that worked precisely because it was his, because the relationship between client and bank was mediated by his personal reputation and his personal guarantee. The idea of selling that institution to a corporation whose character was entirely different from his own was not appealing. Robinson was persistent. The negotiations were lengthy. Eventually, in 1983, Safra agreed to sell the Trade Development Bank to American Express for approximately $550 million, a substantial sum, and one that reflected both the bank's asset value and the premium that Robinson was willing to pay for what Safra had built. The sale came with conditions. Safra agreed to a 5-year non-compete clause that prevented him from operating in the private banking space in ways that would directly compete with what American Express was acquiring. This was standard in acquisitions of this kind, and Safra accepted it. What happened next is one of the more revealing episodes in the history of corporate misconduct. Safra, unable to compete directly during the non-compete period, remained an independent figure with a reputation that was separate from anything American Express had purchased. His clients, many of whom had personal relationships with him that predated and transcended their relationship with any particular bank, maintained contact. Some of them were not entirely comfortable with their accounts now being managed by a large American corporation whose cultural orientation was entirely different from what they had signed up for. American Express discovered fairly quickly that it had purchased an institution whose value was more personal than structural. The Trade Development Bank without Safra was a different institution from the Trade Development Bank with Safra. The clients who had deposited because of the name and the man were not automatically committed to staying because of the name and the corporation. Relations between Safra and his former acquirers deteriorated. The specific grievances on both sides have been described differently by different parties, but the broad outline is consistent. American Express believed that Safra was violating his non-compete agreement by encouraging his former clients to wait out the period and return to him. Safra believed that American Express was mismanaging the institution he had built, and that his former clients had every right to make their own decisions. The situation that developed from this conflict was extraordinary in its scope and in the methods employed. Beginning in 1987, a campaign of disinformation about Edmund Safra began appearing in press outlets around the world. The stories were false, and they were specific. They suggested that Safra's banks had been involved in laundering money for the Medellin cartel. The Colombian cocaine operation, run by Pablo Escobar, that was, in the mid-1980s, the most violent and profitable criminal enterprise in the Western Hemisphere. They suggested connections to the brick scandal, to organized crime figures, to the kind of clients whose money came from sources that would destroy the reputation of any banker associated with them. The stories were planted. They were fabricated, and they were being planted by operatives working for American Express. The mechanics of the operation, when they eventually emerged, were almost impressive in their comprehensiveness. American Express had hired private investigators, including a firm called Kroll Associates, then a reputable corporate intelligence operation, to gather information on Safra. When the legitimate investigation produced nothing incriminating, because there was nothing incriminating to find, the operation shifted to the manufacture of incriminating material. Individuals posing as journalists approached European publications with stories about Safra's alleged criminal connections. The stories were provided with enough authentic-seeming detail to appear credible to editors who had no particular reason to question them. Several publications ran the stories. The disinformation spread. Safra, meanwhile, was watching his reputation, the single most important asset he possessed, the foundation on which everything he had built rested, being systematically attacked. He understood what was happening before he could prove it. He hired his own investigators. He retained lawyers in multiple jurisdictions. He began the slow, expensive, enormously difficult process of documenting an operation that had been specifically designed to be undocumentable. He was, characteristically, meticulous. He gathered evidence with the same precision he brought to account statements and financial reports. Over 2 years, he built a case that was eventually presented to American Express with sufficient specificity that the corporation's internal review concluded that employees had indeed been involved in the campaign. In 1989, American Express issued a formal apology to Edmund Safra. The company acknowledged that employees, specifically an executive named Harry Freeman, had been involved in a campaign that planted false stories about Safra in the press. The company agreed to donate $8 million to charities of Safra's choosing as a form of compensation. Harry Freeman resigned. Several other employees were dismissed. The official accounting attributed the campaign to rogue behavior by individuals acting without corporate authorization, a framing that most observers found convenient but difficult to verify in either direction. Safra accepted the apology. He donated the $8 million to various charitable causes, including Jewish community organizations and medical research institutions. He returned to banking. But the episode had cost him something beyond the 2 years of uncertainty and legal expense. It had demonstrated, in the most concrete possible way, that the reputation he had spent his life building was targetable, that the very qualities that made him valuable to his clients also made him vulnerable to precisely this kind of attack. If you could convince his clients that the trust was misplaced, you could destroy everything he had built without touching a single account balance. He had survived the attack. He had not emerged unchanged. The non-compete period ended, and Safra returned to private banking with a new institution, Republic New York and its sister operation, the Safra Republic Holdings Group in Geneva. He rebuilt the client relationships that had been strained by the American Express years. He expanded into new markets, including Russia in the post-Soviet period, where the enormous wealth being generated by privatization created exactly the kind of client base, wealthy people in politically unstable environments who needed their money managed with discretion across international borders, that Safra had been serving his entire career. The Russian expansion would prove significant in ways that nobody fully understood at the time. It would bring new clients, new money, new complexity, and new categories of risk that private banking in the Sephardic tradition had not been specifically designed to navigate. By the mid-1990s, Safra was richer than he had ever been. His banks were operating at the peak of their influence, and he was spending increasing portions of his time in Monaco, the principality on the French Riviera, where the world's wealthy congregated in a concentration that was almost satirical in its density. He had been diagnosed with Parkinson's disease, which was progressing slowly, but with the consistency of a disease that doesn't stop progressing. His physical condition was increasingly managed by a team of private nurses who were with him around the clock. His world had contracted somewhat from the range of his peak years. He traveled less, attended fewer public events, spent more time in the Belle Epoque penthouse that he and Lily maintained in Monaco. He was 67 years old. His fortune was intact. His reputation had been recovered. His family was secure. Then Ted Ma arrived in his household. The enemies that Edmund Safra accumulated over his career were not, for the most part, the result of personal animosity or deliberate provocation. They were structural, the inevitable product of operating a private bank that served the kind of clients who attract enemies, in the kind of jurisdictions where financial relationships carry political weight. The American Express affair had been the most visible and most documentable attack. But it was not the only source of institutional hostility that Safra had accumulated by the late 1990s. The Russian dimension of his banking operations had introduced new complications that were categorically different from anything he had previously navigated. In the post-Soviet period, from roughly 1991 onward, Russia was experiencing the most rapid and chaotic privatization of state assets in economic history. State enterprises that had been built over 70 years of communist industrial policy were being transferred into private hands at speeds and prices that made rational valuation essentially impossible. The men who emerged from this process with the largest holdings, the oligarchs as they came to be universally known, had accumulated wealth that needed to be managed, moved, and protected in ways that required exactly the kind of international private banking infrastructure that Safra operated. Republic New York Bank became, in the 1990s, a significant conduit for Russian money moving into Western financial systems. The bank processed billions of dollars in transfers from Russian sources during this period. The clients included legitimate businessmen who had navigated the privatization period successfully, as well as individuals whose wealth was connected to the gray and black zones of post-Soviet commerce that were less clearly legitimate. This was not unique to Safra. Every major international bank operating in the 1990s faced the same challenge with Russian money. The difficulty of determining, in an environment where the legal and illegal were thoroughly intertwined, whether the funds being processed had origins that Western regulatory standards would consider acceptable. The Bank of New York would face a major scandal in 1999 over exactly this issue. Deutsche Bank, Credit Suisse, and virtually every other institution with significant Russian business were managing similar questions. What was specific to Safra was the intersection of this Russian exposure with his existing profile as a banker to Middle Eastern and politically sensitive clients. By the late 1990s, Republic New York had attracted the attention of American federal investigators who were examining money flows in multiple contexts: Russian organized crime, Middle Eastern financial networks, the complex transactions that were associated with both, Safra cooperated with federal investigators. This was a decision of considerable complexity, because cooperation meant providing information about clients whose accounts were protected by the same discretion. That was the foundation of his business model. But Safra's commitment to legality was also genuine and deep. His religious framework didn't permit the alternative of simply stonewalling federal investigators. And cooperation appeared to be the option that best served both his legal interests and his ethical commitments. The cooperation made him enemies. Not abstract institutional enemies, but specific people in specific places who had reason to believe that information Safra had provided to American authorities had contributed to their legal difficulties. The Russian organized crime world of the 1990s was not a community that responded to legal exposure with equanimity. Simultaneously, Safra's banking operations had intersected with some of the most contested financial events of the decade. The collapse of the Bank of Credit and Commerce International in 1991, one of the largest banking frauds in history, had touched numerous institutions and individuals with whom Safra had relationships. The various financial scandals involving former Soviet republics had implicated money flows that had passed through Republic New York. None of these connections indicated wrongdoing on Safra's part, but they placed him in proximity to events that attracted the attention of investigators, regulators, and journalists across multiple countries. He had also attracted the specific hostility of elements within the Russian security services, the FSB, successor to the KGB, who had developed particular interest in individuals who were cooperating with American financial investigations that touched Russian oligarchic wealth. The boundary between the Russian state and Russian organized crime in the 1990s was, at best, theoretical, and the interests of both in relation to Safra were convergent. They wanted to know what he had told American investigators, and they were not pleased about the telling. The specific nature and extent of any threats against Safra in the period before his death has been the subject of considerable speculation and very little confirmed evidence. What is clear is that Safra himself felt sufficiently threatened that he had expanded his personal security arrangements substantially in the 1990s. He traveled with bodyguards. His residences had sophisticated security systems. His household staff underwent screening processes that reflected genuine security consciousness rather than the ordinary caution of the very wealthy. His illness added a layer of vulnerability. The Parkinson's disease that had been progressing through the 1990s meant that he was less physically capable of managing his own safety, more dependent on the people around him, more constrained in his movements, more visible in his limitations. The round-the-clock nursing care he required placed him in regular close contact with people he couldn't always fully assess. The nursing care for Safra in Monaco included a rotation of trained nurses who managed his medical needs, his medications, and the various logistical requirements of someone with advancing Parkinson's. The position was demanding. Safra was precise about his requirements, and the household operated at a level of formality and expectation that not every nurse found manageable. One of the nurses hired in 1998 was Theodore Maher, known as Ted, an American who had a background as a Green Beret combat medic and had subsequently worked as a nurse in various capacities. He was 34 years old when he joined the Safra household, physically imposing, apparently competent, and carrying a personal history that the screening process did not fully illuminate. Maher was, by the accounts of people who knew him in the Safra household, an unusual personality, prone to exaggeration, given to stories about his military past that shifted in their details. hungry for recognition, in a way that the professional environment of a private nursing position didn't consistently provide. He had bonded, to some degree, with Safra. The elderly banker apparently liked him, found his American directness refreshing, and had spoken positively about him to family members. He had also, during his time in the household, developed what appears to have been a grandiose fantasy about his own importance to his employer's security. He told other staff members stories about threats against Safra, threats he had uncovered, plots he had foiled, dangers he had detected that nobody else had identified. The stories were not verifiable. They were also not reported to security professionals in any systematic way that might have allowed their assessment. The corporate landscape around Safra in 1999 included one more element that would later attract significant attention. He was in advanced negotiations to sell Republic New York Corporation and his Geneva holdings to HSBC, the Hong Kong and Shanghai Banking Corporation, for approximately $10.3 billion. The deal was one of the largest banking acquisitions in history, and it was essentially complete by December 1999. The paperwork was being finalized. The regulatory approvals were proceeding. Safra stood to receive approximately $3 billion personally from the transaction. His estate, already enormous, was about to become significantly larger. The HSBC deal created a specific financial situation that would later be examined carefully by people trying to understand who benefited from Edmund Safra's death. If Safra died before the transaction closed, the disposition of his shares in the negotiated companies would depend on the structure of his estate and the terms of the deal. The people who stood to inherit those shares, primarily Lily Safra and various family members and charitable entities named in his will, had financial interests that were distinct from Safra's own in the days before the transaction formally concluded. This observation does not constitute an accusation of anyone. Inheritance situations around large estates always create financial structures that are, in theory, affected by timing of death. The Safra situation was unusual in its scale and in the proximity of the timing to the transaction close. But proximity is not causation. What is clear is that on December 3rd, 1999, Edmund Safra was alive and the HSBC deal was not yet closed. And by the morning of December 4th, one of those two things had changed. Monaco on the night of December 3rd, 1999 was what it always was. A principality of extraordinary wealth, compressed into less than a square mile of Mediterranean real estate, its streets quiet, in the way that places where everything costs too much tend to be quiet, its harbour full of yachts whose owners were distributed across the buildings that rose from the waterfront in tiers of improbable elegance. The Belle Epoque was one of those buildings, a residential tower that housed some of the most expensive apartments in one of the most expensive places on Earth. Safra's penthouse occupied the top floor, a sprawling residence that had been customized to his requirements and his security specifications, filled with art and books, and the apparatus of serious wealth maintained by professional staff. On that evening, Safra was attended by two nurses, Ted Maher and a woman named Vivian Torrent. His wife Lily was not in Monaco that night. The household was, in the way of wealthy elderly men who require constant medical management, organized around his needs, his medications, his sleep schedule. What happened between approximately midnight and the moment when fire was discovered has been reconstructed from physical evidence, the testimony of Ted Maher, and the somewhat limited information that can be extracted from the events themselves. The reconstruction, even after a lengthy police investigation and a criminal trial, contains gaps that have never been satisfactorily filled. The official account, which Maher eventually confessed to, and which formed the basis of his conviction, went like this. Maher had become convinced, through a combination of genuine paranoia and the grandiose fantasy life he had been developing for months, that there were intruders in or around the Safra penthouse. He had been making claims about threats and suspicious individuals for some time. On the night of December 3, he decided to stage a small fire in a bathroom of the apartment, a fire that he would then heroically extinguish, demonstrating his value to the household, and perhaps prompting the security upgrade or recognition that his self-image required. The fire, in this account, was supposed to be small and controllable. It was not small and controllable. The materials that Maher used, cotton bandages apparently, burned more vigorously than he anticipated, and the fire spread into areas he had not intended it to reach. He attempted to extinguish it and failed. What happened next was the part that nobody has ever fully explained. Safra was awakened. The fire was visible. The logical response, leaving the penthouse, which was large enough to contain many exits, with the assistance of 2 nurses and the building staff who were responding to the alarm, was available. Instead, Safra barricaded himself in a marble bathroom with Nurse Torrente. He locked the door. He waited. The marble bathroom was, in some ways, a defensible position. Marble doesn't burn. The room was solid, and if the fire was the only threat, waiting in there while staff dealt with the fire outside might have seemed reasonable. But the fire produced smoke, and in a closed marble room is not survivable indefinitely. Safra died of smoke inhalation. Torrent survived, injured. Maher escaped the apartment through a window, injuring himself in the process, and was found by paramedics in the building's grounds. The investigation that followed was conducted by Monaco authorities with assistance from various international agencies. Monaco is a sovereign principality with its own legal system, and the investigation was conducted under its jurisdiction, a fact that some observers later pointed to as limiting the scope and nature of the inquiry. Ted Maher was arrested. He initially denied involvement, then told multiple versions of events that shifted in significant ways across different interrogations. Eventually, he confessed to setting the fire in the terms described above. The staged emergency that went wrong. He was convicted of arson and manslaughter in 2002 and sentenced to 10 years in prison. He was released after serving approximately 5 years. The conviction answered one question: who set the fire? It did not satisfactorily answer a series of other questions that investigators, journalists, and people with knowledge of the Safra case have been raising ever since. The first question is about motive. Maher's explanation, the grandiose act of self-promotion gone wrong, is psychologically coherent in a limited way. People do perform attention-seeking acts that have catastrophic unintended consequences. But the explanation requires accepting that a trained combat medic and nurse, someone with practical experience of fire and trauma and emergency situations, genuinely believed he could contain a fire he had set in a luxury apartment in ways that would produce a heroic outcome rather than a disaster. This requires a degree of delusional thinking that the evidence about Maher's psychological state, while suggesting instability, doesn't fully establish. The second question is about what happened in the bathroom. Safra chose to lock himself in a marble room with one nurse and wait while the other, Maher, was somewhere in the apartment, and the fire was active. For a man who was security conscious to a degree that shaped his entire lifestyle, who had expanded his personal protection substantially in response to what he perceived as genuine threats, this response to an emergency is puzzling. If he believed the fire was a cover for an attack, barricading himself made sense. If he simply believed the fire was a fire, it made less sense. Several people who knew Safra well have suggested that his behavior in the bathroom reflects the possibility that he believed the fire was cover for something else, that there were people in or near the apartment that night whose presence the fire was designed to provide cover for. This interpretation would explain the barricading. It would not explain why he and Torrent ultimately died of smoke inhalation, rather than whatever other threat he was attempting to protect himself from. The third question is about Maher's connections and communications in the period before the fire. Investigations revealed that Maher had been in contact with individuals whose backgrounds were not straightforwardly those of medical professionals or ordinary social acquaintances. Some of these contacts had connections to environments that professional investigators described with the careful vagueness of people who know more than they're prepared to say publicly as organized crime adjacent. Whether these connections were simply the products of Maher's general social instability, a man who moved in whatever circles were available to him, or whether they reflected something more directed, has never been established in evidence that reached a courtroom. The fourth question is about what was not investigated, and by whom and why. Monaco's investigation was thorough by its own account and limited by its jurisdiction and resources. The Principality has a sophisticated legal system, but a small one. The resources that a major national law enforcement agency could bring to an investigation of this complexity, forensic financial analysis, international intelligence cooperation, extended surveillance of persons of interest, were not available to Monaco's authorities in the same way. Several requests for assistance from other jurisdictions produced varying degrees of cooperation. American federal investigators who had been in contact with Safra about Russian money flows were not, as far as the public record shows, significant contributors to the Monaco investigation's findings about possible external involvement. The HSBC transaction closed after Safra's death, transferring his banking empire to the British institution as planned. Lily Safra inherited the bulk of his personal estate, a fortune that had grown to somewhere between $5 and $5 billion, depending on which assets were included in the calculation. She has spent significant portions of it on charitable causes, particularly medical research. Ted Maher, released from Monaco prison, returned to the United States and gave a series of interviews in which his account of events continued to shift. In some versions, he maintained the original confession. In others, he suggested that his confession had been coerced, or that it was incomplete, that what he had done was not the full story of what had happened that night. He has never provided a version of events that satisfactorily resolves the questions that his original confession left open. The Monaco fire killed one of the most significant private bankers of the 20th century. 8 days before Christmas 1999, on the eve of a transaction that would have cemented his legacy and substantially increased his already enormous fortune. The official explanation, a nurse's staged emergency gone catastrophically wrong, is the conclusion that a legal process reached and a conviction confirmed. It is also a conclusion that people who knew Edmund Safra, people who have studied the Safra case, and people who understand the environment in which he operated continue to find insufficient. Every unsolved mystery, or every mystery that feels unsolved despite a legal verdict, has a set of questions that the official explanation doesn't adequately address. The Safra case has several, and they cluster around specific aspects of the events of December 3rd, 1999. and the context in which those events occurred. The first and most fundamental is the question of what Ted Maher was actually doing in the Safra household, and who, if anyone, had put him there. Maher's hiring process went through the agency that supplied the Safra household's nursing staff. His background was checked, his credentials were verified, and he was approved for a position that required significant trust. He was, after all, in close physical proximity to one of the world's wealthiest and most security-conscious men on a daily basis. The screening process did not disqualify him. What the screening process apparently did not fully illuminate was the full texture of Maher's background, his psychological profile, or his outside connections, the details of how he came to be specifically hired for the Safra position, as opposed to other nursing positions that might have been available through the same agency, have never been made fully public. This matters because placement is a standard technique in operations designed to gain access to a target. If someone wanted to get a person close to Edmund Safra, placing that person through a legitimate employment pathway. As a nurse, a position that required trust and generated physical proximity, was a far more viable approach than any more direct method. Whether Maher was placed deliberately or simply arrived through ordinary employment channels is a question that the investigation's public record does not definitively answer. The second cluster of questions concerns the Russian dimension of Safra's business and the specific people who had reason to be hostile to him in the period before his death. By 1999, the Russian financial crisis of 1998 had restructured the landscape of post-Soviet wealth in ways that had consequences for everyone who had been operating in that space. The ruble's collapse and the sovereign debt default had destroyed some fortunes and reshuffled others. The American federal investigations into money flows through Republic New York Bank. Investigations that Safra had cooperated with had resulted in various legal difficulties for various individuals. The people who had been harmed by Safra's cooperation with American investigators were not abstract. They were specific individuals with resources, connections to security services and organized crime structures, and a demonstrated willingness to address their problems through methods that Western law enforcement preferred to prosecute rather than replicate. The question of whether any of these individuals had an interest in what happened in Monaco on December 3rd, 1999 was one that investigators were aware of and that the public record suggests was not exhaustively pursued. The specific figure who has attracted the most attention in this context is not a name that appears in the Monaco investigation's findings, because the Monaco investigation's findings were focused on what could be proven rather than what was suspected. But the world of Russian organized crime and its intersection with the post-Soviet security services, the FSB, the Military Intelligence Directorate, the various private security companies that employed former intelligence officers, was not an environment where the death of a witness who had been cooperating with American investigators would go entirely unnoted. The third set of questions concerns the specific behavior of everyone in the Safra penthouse on the night of the fire, and what it suggests about what they expected to happen. Maher's behavior, setting a small fire, then apparently panicking when it spread, is explicable on the official theory. His attempt to escape through a window, injuring himself in the process, is consistent with someone whose plan had gone catastrophically wrong and who was trying to limit his own exposure. Torrent's behavior, staying with Safra in the locked bathroom while the smoke built, is harder to explain on any theory. She was a trained nurse. She understood what smoke inhalation does. She had the physical capability to leave the bathroom and the penthouse, or at minimum to open the bathroom door when it became clear that remaining inside was fatal. The official explanation attributes her presence in the bathroom to the instructions of her employer. Safra had barricaded himself and asked her to stay, and her survival, despite the same exposure that killed him to the varying oxygen concentrations in different parts of the room. This explanation is physically plausible. It requires believing that a trained medical professional in a life-threatening situation deferred to the instructions of an elderly, ill man rather than making an independent judgment about how to preserve both their lives. People do defer to authority in crisis situations in ways that later seem irrational. This is documented in psychology. It is also, in this specific case, a somewhat difficult behavior to fully understand. Torrente gave testimony in the Maher trial and has maintained, consistently, that the events were as described in the official account. She has not suggested any alternative explanation. Her testimony was accepted by the court. The fourth question concerns the HSBC transaction and its timing, the sale of Republic New York Corporation and the Geneva operations to HSBC for $10. $3 billion was structured so that Safra's personal shares, worth approximately $3 billion, would transfer on his death to his estate, which was principally Lily Safra and the charitable foundations he had established. The transaction's closing date and the specific terms affecting the disposition of shares in the event of Safra's death have never been made fully public in the detail that would allow independent analysis of who benefited most from the timing. This is not an accusation. Safra had constructed his estate over decades, and its structure reflected his own intentions, not the plans of any external party. Lily Safra has been a consistent and apparently genuine philanthropist since her husband's death, donating hundreds of millions of dollars to medical research and other causes in his name. But the timing, the death 8 days before Christmas, with the transaction in final stages, creates a financial context that investigators and journalists have consistently noted, and that has never been fully addressed in public documentation. The fifth and perhaps most troubling question concerns the nature of the investigation itself. Monaco is a sovereign jurisdiction with a legitimate legal system and professional law enforcement. It is also a principality of approximately 40 residents whose economy is substantially dependent on the goodwill and continued presence of the extremely wealthy people who choose to live and bank there. The investigation of the death of one of those extremely wealthy people, in circumstances that touched on Russian organized crime, international financial investigations, and some of the most sensitive aspects of late 20th century private banking, created institutional pressures that would have been difficult to navigate cleanly. The official version of events, Maher acting alone, with no outside connection or direction, for reasons of personal grandiosity, is the version that allowed the case to be closed, a conviction to be obtained, and the broader questions to be set aside. Whether this version is complete, or whether it is the largest portion of a truth whose remaining portions would have required investigation that Monaco couldn't or wouldn't conduct, is something that public record genuinely does not resolve. Several journalists who have investigated the case extensively, including the American reporter Alan Furr, who wrote about it for the New York Times, and the author Daniel Ammon, who produced the most comprehensive book-length account, have noted the same gaps and have reached the same tentative conclusion. that what happened in Monaco on December 3rd, 1999 is probably more complex than the official verdict describes, and probably less complex than the most elaborate conspiracy theories suggest, and that the precise location on that spectrum is unknowable given the evidence currently in the public domain. In the years since Safra's death, the banking world he inhabited has changed substantially. Republic New York was absorbed into HSBC as planned. The Trade Development Bank is long since dissolved into the larger institution. The Safra Republic Holdings in Geneva was restructured. Banco Safra in Brazil remains an independent institution, still operated by members of the Safra family, specifically by Joseph Safra, Edmund's brother, and his descendants, who have built it into one of the most significant private banks in Latin America. The charitable legacy Edmund Safra established has continued and expanded. The Edmund J. Safra Foundation has funded medical research at institutions around the world, with particular focus on neurological diseases, a commitment that reflects Safra's own experience with Parkinson's disease and his desire to support research that might spare others that particular suffering. The Edmund J. Safra Centers for Ethics at Harvard and Tel Aviv University bear his name on institutions of genuine scholarly seriousness. Lily Safra, who outlived her husband by decades, became one of the significant philanthropists of her generation in her own right, a continuation and expansion of the charitable engagement that had characterized her public role during the marriage. She died in June 2023 at the age of 87, one of the last direct witnesses to the full arc of the story. The Safra family's Syrian Jewish community, the SY community that Jacob Safra had been part of in Aleppo before the migrations began, has itself been dispersed across New Jersey, New York, Mexico, and various other locations where Sephardic communities established themselves across the 20th century. The commercial culture that had produced Edmund Safra, the emphasis on trust, on discretion, on family-based financial networks, persists in attenuated form in those communities, though the specific conditions that made it so powerful in the banking context of the mid-20th century have changed substantially. Private banking itself has changed. The banking secrecy laws that made Geneva so valuable to Safra's clients were progressively eroded over the first 2 decades of the 21st century as American and European regulatory pressure forced Swiss institutions to share information that had previously been protected absolutely, the kind of absolute discretion that Safra had offered. The guarantee that no government would ever know the details of your account became harder and eventually impossible to provide within legal frameworks. The clients who had valued that discretion most highly, who had needed it not for tax evasion but for genuine personal security in politically unstable countries, lost something that had genuinely served a protective function. The coincidence of this regulatory change with the post-9/11 global focus on financial flows and the post-2008 focus on tax avoidance produced an environment in which the Safra model of private banking became increasingly difficult to operate. What remains at the end of the Safra story is the specific texture of a life that was built on trust and ended in a fire whose full explanation remains incomplete. Edmund Safra spent 40 years demonstrating, through the daily conduct of his business, that financial relationships built on integrity and discretion could survive the attacks of larger competitors, the political upheavals of the countries his clients came from, and the general noise of an industry that was becoming more transparent and more regulated in ways that worked against everything his model had been built on. He survived all of that. He built banks that lasted. He accumulated a fortune that funded institutions that will carry his name for generations. He cooperated with federal investigators at personal risk because his religious and ethical commitments didn't permit the alternative. And he died in a smoke-filled bathroom in Monaco, barricaded behind a locked door, in circumstances that a legal verdict described, and that the people who knew him best have never entirely believed. The banking dynasty he built is documented. The mystery that ended it is not fully resolved. The smoke from the Belle Epoque cleared. The questions remain. In the world of private banking, the discrete, relationship-based, intensely personal financial world that Safra had inhabited for his entire career, the accepted wisdom is that secrets are protected not by locks and walls, but by the willingness of the people who hold them to keep holding them. Safra had kept secrets for decades. He had protected his clients with a consistency that was the foundation of everything he built. Someone, or something, ensured that his own secrets, the things he knew, the information he had provided to investigators, the full texture of the relationships that had made him both valuable and vulnerable, would stop accumulating after the night of December 3rd, 1999. Whether that someone acted through Ted Maher, or whether Ted Maher acted alone for reasons that remain psychologically incomplete, is a question that the official verdict answered, and that the evidence surrounding that verdict continues to complicate. Edmund Safra was 67 years old. His banks were healthy. His fortune was about to be substantially increased by the HSBC transaction. His charitable work was ongoing. His illness was progressing, but not imminently terminal. He had more years to live, more money to give away, more history to make. The fire took all of that. Whether it took it for the reasons the court described, or for reasons that the court's inquiry didn't fully reach, is the question that still echoes through the world of private banking and international financial intelligence. A world that knows, from experience, that the most important questions are not always the ones that get answered in public. The Safra family mystery doesn't end with a verdict. It ends with smoke and a locked door and a dead man who knew too much about too many things that too many powerful people preferred to keep quiet. That's where the official story stops. That's where the real questions begin.